Welcome to the deep dive. Today we are taking a look at the recent Q3 2025 earnings call for Pagaya Technologies Ltd, ticker PGY.
Right.
And this wasn't just another quarterly check-in. It really felt like a moment that signaled a major acceleration. And you saw that in how the stock reacted.
It was a classic beat and raise quarter, for sure.
Yeah?
But, what really stood out to me wasn't just the numbers. It was the story behind them.
Okay.
It was about clean, GAAP-level profitability. And it was achieved through some really disciplined scaling. So today, we're going to dig into why management felt so confident raising their targets and, maybe more importantly, how their B2B model is supposed to insulate them from these bigger credit cycles we're seeing everywhere else.
Right, this whole story of profitable resilience. So, okay, let's start with that high-level summary, the numbers that drove that immediate, pretty visceral market reaction.
Yeah, let's go.
Top line, total revenue and other income hit $350 million. That's a 36% jump year over year.
Which, just for context, was way ahead of what analysts were looking for.
Yeah.
The street was somewhere around 335, maybe 338 million. So they just blew past it.
They crushed the top line. And then you look a little further down the income statement, and the profitability story just gets better.
It really does. The non-GAAP EPS was about $1.02.
And the consensus was what, 56 cents?
56 cents. So they nearly doubled it. When you see a company double profit, estimates, something structural is happening. It's not just a one-off good quarter.
And the really big one, especially for a high-growth fintech platform like this, they finally flipped that major switch. GAAP EPS came in positive.
Positive at 30 cents.
Yeah.
Compare that to a net loss this time last year.
Yeah.
That's the milestone Wall Street really values, especially right now. It signals sustainability.
And it all ties back to the margin expansion, right? Where is that leverage coming from?
It's coming from adjusted EBITDA. It just soared, up 91% year over year to 107 million. That isn't just growth. That's growth that's dropping straight to the bottom line because their cost base isn't growing nearly as fast.
A 91% increase. That tells you the cost of running their AI network, the engine, just isn't keeping pace with the revenue that engine is generating.
Exactly. And that's why you saw the stock spike something like 17 to 20% in the pre-market.
Yeah.
Investors saw clear evidence of scalable, profitable execution.
Okay, so let's move past the headlines and look at the engine room itself, the operational metrics, the unit economics,
Right.
network volume, so that's the total amount of loans flowing through their system, reached 2.8 billion. That's 19% growth. Solid, but not explosive.
But here's the fascinating part. The volume grew 19%, but the metric they use for efficiency grew way faster.
You're talking about the FRLPC, fee revenue less production costs.
Exactly. And that number grew 39% to 139 million. That, to me, is maybe the single most important nugget from the whole call.
That divergence is key. So it's not just about finding more loans. They're actually making more money on each loan that goes through the system.
It's a strategic choice they made.
Yeah.
They are monetizing more efficiently. So that growth in FRLPC, it translated to a 70 basis point improvement in monetization efficiency. It's now at 5% of network volume.
It's like they're making more on every single transaction, which is driving that huge EBITDA expansion we were just talking about.
Precisely. And that focus on the unit economics, it's giving them strategic flexibility.
Yeah.
You could see it in their portfolio diversification.
Yeah, they're proving the model works beyond just personal loans.
Absolutely. Auto and point-of-sale lending now make up 32% of their total network volume. A year ago, that was just 9%.
That's a huge shift.
It's a dramatic expansion. It shows that their AI engine isn't just for one product. It's a financial utility you can deploy across a massive market.
Let's talk about stability, because that's what everyone's worried about in this macro environment. This was their third consecutive quarter of positive GAAP net income. That consistency is exactly what the market wants to see.
And that stability is built on some really strong cash generation. Operating cash flow hit a record $67 million. That's real cash.
And at the same time, they showed some incredible discipline. Core operating expenses dropped to the lowest level since they went public.
Just 34% of that FRLPC metric. I mean, think about that. You're reducing your core operating costs while your network is growing and you're raising guidance. That is the literal definition of operational leverage.
The message was loud and clear: prudent underwriting and building a through-the-cycle business.
Right. And prudence requires capital. Which brings us to the next part of the call, where they detailed some really proactive and frankly pretty smart moves on their capital structure.
This is probably the most critical part of their operation to understand.
I think it is. They need stable, low-cost funding to make the whole thing work.
Okay, let's dive into that. They raised $500 million in rated corporate debt. They also expanded their corporate revolver to $132 million. What does that actually mean for them?
It means they've secured long-term anchor funding. It removes a huge risk factor. That $500 million is like a fixed, reliable foundation for their balance sheet.
And the revolver.
The revolver expansion is really telling. They didn't just expand it, they renegotiated it at an interest rate that's almost 35% lower than before.
Slashing their own borrowing costs by that much in this environment. That's a huge advantage.
It is. It lowers their effective cost of capital, simple as that. And on top of that corporate funding, they also showed there's still really robust demand for their securitized products. They've done over $1.8 billion in asset-backed securities, or ABS, this year.
Okay, but I saw they also announced moves to diversify away from being 100% reliant on ABS.
Yes, and this is the crucial risk mitigation step. The ABS market can be volatile sometimes.
So what are they doing?
They secured a major auto forward flow agreement with Castle Lake. That's for up to $500 million. And they sold what are called residual certificates to 1 William Street. They're now targeting a 50-50 mix between ABS and these other structures.
Okay, break that down. A forward flow agreement is like a pre-order for loans.
That's a great way to put it. It's a commitment from an investor to buy a pre-agreed volume of loans over time. It gives Pagaya guaranteed, predictable cash flow without having to go out and structure a new ABS deal every month.
And the residual certificates, that sounds technical.
It is a bit, but it's important. In any securitization, there's a small, high-risk, high-reward piece left over. That's the residual. The fact that they can sell that risk to a big institutional investor is a massive vote of confidence in the quality of their loans.
They're taking risk off their own books.
Exactly. And freeing up capital, they can immediately reinvest into growth. That's something they hadn't done since 2021, and doing it now just confirms that the market trusts their underwriting.
So all of these complex moves, what's the big picture takeaway?
The takeaway is that they've stabilized their funding costs, they've massively improved their capital efficiency, and they've ensured the platform can scale without hitting a liquidity wall. They've basically diversified their fuel source.
And that strategic safety net is the justification for raising their guidance.
It has to be, which leads us perfectly into those new targets.
Let's run through them. For the full fiscal year 2025.
They raised everything. Total revenue and other income now guided to between 1.3 and 1.325 billion.
And adjusted EBITDA.
Between 372 and 382 million.
And the number that I think should really stick with you, the listener, GAAP net income now guided between $72 and $82 million. Meaningful, clean profit for the whole year.
Yeah. And Q4 is projected to continue that momentum. This isn't just a blip. They are institutionalizing a new higher run rate for the entire business.
Okay, so let's connect that guidance to their growth engine. The B2B strategy, their partner pipeline, what's giving them this confidence?
It comes down to what they call the partnership flywheel. The CEO said they have the highest number of partners ever in their onboarding queue.
How many?
Up to 8 partners, a mix of big fintechs and banks, all set to go live in the next 12 months.
So this isn't just a hope for future growth. It's a committed pipeline waiting to be turned on.
Exactly. And they're shifting their focus from just transactional volume to building these deep institutional relationships, multi-year contracts, growing accounts into billion-dollar relationships over time.
Is it still a huge lift to get these new partners onboarded? That's always the bottleneck.
Well, they highlighted that as a key operational advantage now.
Yeah.
They've streamlined it. New partners can use pre-built integrations with platforms like Credit Karma and Experian.
So it accelerates the time to value.
Massively. It means those 8 partners in the queue can start driving volume much, much faster than was possible even a year ago.
And the proof is with their existing partners.
It is. They pointed out that partners who use them for multiple products, say auto and personal loans, still only make up about 30% of their base.
But I bet they drive most of the volume.
Over 2/3 of the volume. So you see this huge organic same-store growth opportunity just by converting the other 70% of their partners to multi-product users.
Right.
The growth is already embedded in the platform.
We have to talk about the elephant in the room for any financial company right now. Consumer credit.
Right. The normalization, the rising delinquencies.
What did management say to calm investor fears?
They were very clear. They said credit performance remains stable and well within expectations. They stress that this isn't just luck, it's the result of a disciplined underwriting approach they've had in place since the start of 2024.
Talk is one thing. Did they give any hard data?
They did, and it's pretty compelling. For personal loans, the 2024 vintages are seeing net losses that are trending 35 to 40% lower than the peaks in 2021.
And for auto loans?
Even better. Losses are trending 50 to 65% lower than comparable periods in 2022. The AI is clearly doing its job of segmenting risk effectively.
And this all comes back to their big philosophical point, the B2B immunity claim.
Yeah, how their model is designed to resist these cycles better than a traditional lender. A typical BTC lender's gross is tied directly to their marketing spend and their approval rate.
So when the credit cycle turns, they have to slash both, and their growth falls off a cliff.
Precisely. Pagaya doesn't have that direct link. Their growth comes from integrating with large, stable financial institutions and expanding within them. The volatility is just structurally lower. They're not totally immune, but the impact is much more muted.
And they said they're already positioned for any potential future weakness.
Yes. Management confirmed the current guidance already includes a cushion for future credit-related impairments, something like $25 to $37.5 million per quarter. It's already baked in.
A very comprehensive picture of what was a really pivotal quarter for them. But before we wrap up, we have to transition to our This Is Not Financial Advice segment.
Indeed. We have to remind you, this is all for informational and entertainment purposes only. We are not recommending any investment strategy. We're just here to pitch the outrageous but plausible trade idea that synthesizes the takeaways from this deep dive.
All right, lay it out. If you are absolutely convinced this acceleration is real, how do you play it?
Okay, so the core thesis is this. The market has not fully priced in the insane operating leverage that's coming when they convert this record high partner queue into mature billion-dollar relationships over the next 18 to 36 months.
And the funding risk is off the table.
The funding risk is largely off the table. The engine won't choke. So if that long-term compounding is your thesis, you want a structure with leverage.
Okay.
The trade would be to use a call spread. You buy a near-the-money call option, and you sell an out-of-the-money call option, both expiring in early 2027. That gives them plenty of time for the story to play out.
And how do we juice the trade, make it even more aggressive?
To partially fund that long-term call spread, you sell out-of-the-money puts that expire in mid-2026.
So you're making a shorter-term bet on their underwriting.
You're making an implicit bet on management's prudent underwriting and the strong credit data we just talked about. It's a bet that near-term credit noise won't break the model and allows you to capitalize heavily on that long-term B2B flywheel effect.
A very convicted structure. So to recap our deep dive, a huge beat and raise quarter, dramatic margin expansion, a de-risked capital structure, and a B2B model that's firing on all cylinders with a record partner pipeline.
The story is clearly shifting to profitable, stable scale. So the question for you, the listener, is what's the biggest remaining external risk? They seem to have handled the balance sheet. So is it consumer credit volatility, or is it something like capital market spreads? And how long can they really stay insulated when even their big bank partners are feeling the pressure?
An excellent thought to end on. That concludes this deep dive. Thank you for tuning in. The information contained herein is for informational and educational purposes only and does not constitute investment advice. Consult a licensed professional before making any investment decisions.